Welcome back to the Pro Ticker Podcast, everyone. Your Monday morning edition covering major financial magazine headlines. It's December 23rd,
Oh, wow.
and we've got a fascinating stack of articles
Okay.
from Bloomberg Market Watch and CNBC to unpack.
Sounds good.
It's not just the holidays.
Right.
It's the end of a crazy year. Andy, we're heading into a new U.S. presidency with all its unknowns.
Absolutely. Understanding these market forces is going to be crucial for anyone who wants to navigate the financial landscape in 2025.
Okay, let's dive in. First up, the dollar.
Mm-hmm.
CNBC says it's been on a tear lately, hitting a two-year high.
Wow.
Meanwhile, the euro is down 5.5% this year, struggling near its November low.
Hmm.
Not exactly holiday cheer for the Eurozone, huh?
Not quite. The dollar's strength is partly due to recent U.S. inflation data. It's eased fears of aggressive rate cuts,
Makes sense.
making the dollar more attractive. The Federal Reserve's projected pace of rate cuts actually surprised markets, sending Treasury yields and the dollar surging.
Interesting.
But here's where it gets interesting. A strong dollar isn't always good news.
Oh,
It can impact emerging markets negatively, making it harder for them to service their dollar-denominated debt.
so a strong dollar is a double-edged sword. What does this mean for investors, though? Should we be stocking up on dollars?
It's not that simple.
Okay.
A strong dollar could benefit certain sectors like U.S. exporters
Right.
or companies with significant overseas earnings.
Uh-huh.
On the other hand, it might hurt companies that rely heavily on imports. It's all about understanding the nuances.
Makes sense.
Oh.
Speaking of currencies under pressure, Bloomberg is reporting that the Japanese yen is near a 5-month low against the dollar, and officials are getting worried. What's the story there?
The Bank of Japan's decision to hold rates steady is a major factor here.
Okay.
Remember, interest rate differentials play a big role in currency valuations.
Right.
When one country offers higher interest rates than another, investors tend to flock to the higher yielding currency,
Okay.
putting downward pressure on the lower yielding one. Right now, that's the yen.
And I imagine a weak yen can have a ripple effect throughout the Japanese economy, right?
Exactly. A weaker yen makes imports more expensive, which
Ah.
can impact everything from consumer goods to energy prices in Japan. This could potentially lead to higher inflation and squeeze consumer spending.
Mhm.
On the flip side, it can make Japanese exports more competitive, which could be a boon for certain industries.
Interesting. So it's a mixed bag for Japan. Now let's shift gears to Europe, where Bloomberg is reporting on a potentially explosive situation with natural gas. Apparently, a crucial deal allowing Russian gas transit through Ukraine is set to expire at the end of the year,
Yeah,
and things aren't looking good.
this is a critical development with far-reaching implications. If this deal collapses, Slovakia and other countries dependent on this pipeline will need to find alternative sources of natural gas.
Okay.
And those are likely to be more expensive. This could have a significant impact on European energy prices,
Okay.
especially considering that natural gas storage levels are lower than last year.
That doesn't sound good.
Yeah.
What are the potential consequences for European businesses and consumers?
Well, higher energy prices could lead to increased production costs for businesses,
Right.
which might ultimately be passed on to consumers.
Makes sense.
We could see a rise in inflation and a slowdown in economic growth. And with concerns about a potential windless period hitting Northwest Europe soon, the demand for natural gas as a power generation fuel could spike even further, exacerbating the situation.
Wow, this gas situation is a real wild card.
Yeah.
What does this mean for investors, though? Are there any potential opportunities amidst all this uncertainty?
There might be. For example, this could be a good time to consider investing in alternative energy sources like wind and solar,
Okay.
or in companies involved in LNG, liquefied natural gas infrastructure.
Mhm.
As Europe seeks to diversify its energy sources, these sectors could see significant growth.
Okay, so there could be some silver linings for savvy investors. Speaking of investments, let's check in on the European stock market.
Uh,
CNBC is reporting that the Stocks Europe 600 index,
mhm.
which tracks 600 of the largest companies across various European sectors, saw a slight gain, but it's been a rough December overall. What's dragging down European markets?
A lot of it has to do with lingering uncertainty around U.S. Fed policy
Okay.
and the potential for trade wars under a Trump presidency.
Right.
Investors are holding back, waiting to see what concrete policies emerge and how they might impact the global economic landscape.
So a classic wait-and-see approach.
Yeah.
It seems like uncertainty is the name of the game these days.
Yeah.
But what about safe haven assets like gold? CNBC mentions that gold prices saw a slight uptick,
Okay.
although the overall trend has been downward.
Mm.
Is gold losing its luster as a safe haven?
That's a great question. Historically, gold has been seen as a hedge against inflation and economic turmoil. But with the Fed signaling fewer rate cuts than anticipated and inflation seemingly under control, gold's appeal as a safe haven might be diminishing.
So maybe it's not time to rush out and buy gold bars just yet. Now, for something completely different, Bloomberg reports that South Korea is planning to issue one-denominated foreign exchange stabilization debt
What?
for the first time in over 20 years. What's the thinking behind this move?
It might seem counterintuitive,
Right.
but this is actually a strategy to counter a 2-0 strong one.
Interesting.
A strong currency can make a country's exports less competitive on the global market, hurting industries that rely on overseas sales. By issuing this debt, South Korea is essentially trying to weaken its currency slightly to boost its export competitiveness.
That's fascinating. It's a reminder that even a strong currency can pose challenges. Speaking of governments making bold moves, that brings us to the buzz around Bitcoin. And President-elect Trump MarketWatch is suggesting that the U.S. might create a national Bitcoin reserve under a Trump administration.
Really?
Yeah.
Huh.
A very polarizing topic
Yeah, it is.
with strong arguments on both sides.
For sure.
So let's unpack that a little bit after a quick break. We'll be right back with more market insights and analysis after this.
Welcome back, everyone. Before the break, we were discussing the possibility of a U.S. Bitcoin reserve under a Trump administration. It's a polarizing topic with strong arguments on both sides.
Yeah, I'm still trying to wrap my head around it. On the one hand, I can see how a Bitcoin reserve could potentially benefit the U.S., but on the other hand, it seems incredibly risky.
Exactly. It's a classic risk-reward scenario. Proponents argue that a Bitcoin reserve could act as a hedge against inflation and solidify the U.S.'s role in financial innovation. They also believe it could strengthen the U.S. dollar's global standing and potentially even help reduce the national debt.
But wouldn't it also be a huge gamble? Bitcoin is notoriously volatile. What if the price crashes?
That's a valid concern. Critics argue that a Bitcoin reserve would expose the U.S. to unnecessary risks and potentially even destabilize the financial system. They also point out that legitimizing Bitcoin could undermine traditional financial institutions and create opportunities for illicit activities.
So it's a complex issue with no easy answers. It'll be interesting to see how this plays out. But let's move on to something a bit more concrete. MarketWatch has an article about the Eaton Vance Enhanced Equity Income Fund, too, or EOS for short. They say it's a closed-end fund with an impressive track record.
Yes, EOS has been attracting a lot of attention lately. It's got a 5-star rating from Morningstar and has been around for 20 years, consistently delivering solid returns.
I'm intrigued, but also a bit skeptical. An equity fund focused on income, wouldn't that underperform the broader stock market, especially with the S&P 500 doing so well?
That's a common misconception. While EOS does focus on income, it also aims for capital growth. In fact, over the past 5 years, it has returned 94.5% on a total return basis. That's not far behind the SPDR S&P 500 ETF Trust, 5-year return of 98.3%, and over a 10-year period, EOS actually outperforms the S&P 500 with a return of 254.2% compared to 238.5% for SPY.
Those are impressive numbers. But what's their secret sauce? How are they achieving these returns?
They use a clever strategy involving covered call options. Essentially, they write call options on almost all the individual stocks held by the fund. This generates premiums, which contribute to the monthly distributions for shareholders. They're essentially boosting income by strategically using options.
Interesting. But how do they choose which stocks to include in the fund in the first place?
Their approach is more growth-oriented than you might expect. The fund manager selects stocks from the Russell 1000 Growth Index, focusing on companies with the potential for stable and consistent growth. They look for companies with strong leadership, a loyal customer base, and a large addressable market.
So they're not just chasing high dividend yields. They're looking for quality growth companies that can generate both income and capital appreciation.
Precisely. It's a balanced approach that has proven successful over the long term. And here's another interesting thing about this fund. It's a closed-end fund, which means it has a fixed number of shares that are publicly traded. This structure allows them to maintain a steady distribution payout even during periods of market volatility.
I'm familiar with the concept of closed-end funds, but could you explain how this structure helps them keep those distributions flowing?
Unlike open-ended mutual funds where the manager has to constantly adjust the portfolio based on investor inflows and outflows, a closed-end fund has a set pool of assets. This means they don't have to sell positions just because investors are redeeming shares, which can be a real advantage during market downturns. And because of this structure, their monthly payments to investors can include returns of capital.
Returns of capital. That sounds familiar, but could you remind me what that means exactly?
Essentially, it means that part of the distribution you receive as an investor is actually your own money being returned to you. Now, I know that might sound strange, but it's actually a tax-efficient strategy because the fund holds a lot of growth stocks that have appreciated in value. They're sitting on unrealized capital gains. So instead of selling those positions and triggering a taxable event, they can return some of that capital to you. This reduces your cost basis and defers taxes until you eventually sell your shares.
All right. I remember now. So it's not all taxable income. That's good to know. But with a focus on growth stocks, I imagine this fund could be quite volatile, right?
That's true. In 2022, when the overall market was down, EOS declined 26.5%. However, its long-term performance has been impressive, and the fund is structured to provide consistent income even during turbulent times.
I see. So it's a potential option for someone who needs current income, but also wants to participate in potential capital growth and has the patience to ride out market fluctuations.
Exactly. It's not for the faint of heart, but if you're looking for a long-term income solution with a solid track record, this one is definitely worth considering.
Lots to think about there. Speaking of things to think about, MarketWatch also had an article about the potential for a Santa Claus rally. What are the chances of that happening this year?
Historically, the stock market tends to perform well during the holiday season with the Santa Claus rally period starting on Christmas Eve and running through January 3rd. Since 1950, the S&P 500 has gained an average of 1.29% during this 7-day stretch and ended higher 77% of the time. However, last year, we didn't see a Santa rally, and this year is already off to a bit of a rocky start with the Dow down in December.
So it's not a sure thing by any means.
Yeah.
What are some of the factors that could make or break a Santa Claus rally this year?
Investor sentiment is always key. Right now, there's a lot of uncertainty around Fed policy, inflation, and of course the incoming Trump administration and its potential impact on trade and immigration policies. If investors are feeling optimistic and confident about the future, we could see a rally, but if fear and uncertainty continue to dominate, it's likely to be a muted holiday season for the market.
It certainly sounds like we're in for an interesting ride in 2025. Before we wrap up, I want to circle back to the European energy situation. With all the uncertainty surrounding Russian gas, are there any other energy sources Europe could turn to?
Well, one option that's been gaining traction is liquefied natural gas, or LNG.
Okay.
Bloomberg highlights how several European countries are already expanding their LNG import terminals to accommodate more shipments from suppliers like the United States and Qatar. This could provide a much-needed alternative to Russian pipeline gas.
So there's a potential shift happening in the global energy landscape.
Absolutely. The European gas crisis could accelerate the transition to a more diversified and flexible energy market, with LNG playing a key role. And this could create opportunities for investors who are looking to capitalize on this trend.
Interesting. Any specific companies or sectors you have in mind?
Well, companies involved in LNG production, transportation, and infrastructure could benefit from increased demand.
Right.
For example, Cheniere Energy is a major U.S. LNG exporter, and companies like Flex LNG and Golar LNG specialize in LNG shipping.
Oh.
These are just a few examples, of course.
Okay, so there's a whole ecosystem developing around LNG. It's fascinating to see how geopolitical events can drive innovation and investment. But before we get too sidetracked by energy, I want to touch on one more thing. MarketWatch mentioned something called the Rigetti Computing Company. Any insights on that?
Yes. Rigetti Computing is a player in the exciting world of quantum computing, and their shares have been surging in pre-market trading. This seems to be driven by the recent buzz around Google's Willow quantum chip, which has investors betting on the future of this groundbreaking technology.
Quantum computing. It sounds so futuristic. I have to admit, I don't really understand what it is or what the implications are.
It's a complex subject, but in simple terms, quantum computing harnesses the principles of quantum mechanics to perform calculations in a fundamentally different way than traditional computers. This allows them to tackle problems that are currently intractable for even the most powerful supercomputers.
So what kind of problems are we talking about?
Well, the potential applications are vast. Quantum computers could revolutionize fields like medicine materials, science, finance, and artificial intelligence. Imagine being able to develop new drugs and therapies at an unprecedented pace, or design materials with entirely new properties. Or imagine financial models that can accurately predict market movements, or AI systems that can truly understand and respond to human language. The possibilities are mind-boggling.
It sounds like something out of a science fiction movie.
It does, doesn't it?
Yeah.
But it's becoming a reality. And while there are still many challenges to overcome, the progress being made in quantum computing is remarkable. It's definitely a space to watch closely in the coming years. And Rigetti Computing is one of the companies at the forefront of this revolution.
Well, on that note of technological marvels and potential market disruptions, I think it's time to wrap up this deep dive. It's been a fascinating look at the forces shaping the financial landscape as we head into the holidays and New Year. As always, there's a lot of uncertainty out there, some risks, but also some exciting opportunities on the horizon.
Indeed. And I think the key takeaway for investors is to stay informed, to do their research, and be prepared for a dynamic and ever-changing market environment.
Wise words. Thanks for joining us on this whirlwind tour of the financial markets. We'll see you all tomorrow morning with fresh headlines from major financial magazines. Until then, happy investing and happy holidays.